Janet, your take on Europe right now. Are they in recession? Are they heading to recession?
I don't think Europe is having a recession right now, but obviously in terms of the sector, the industrial sector is particularly weak. What we see is the PMI is in contraction, and the factory orders in Germany is really weak, the weakest since the financial crisis. So it's very sector specific, and so far in terms of the consumer sector, it's doing okay. Unemployment rate is still falling, lower since the crisis, and so far there hasn't been a spillover of the weak industrial sector to the consumer sector. So I would still say that the Eurozone economy is growing still modestly on a quarter-on-quarter basis, and is still like above 1% growth year on year. So we're not in a recession, but it really depends on whether still weaker manufacturing sector would filter into the consumer sector.
Mike Bell,
there's no evidence.
Mike Bell, I want to go to this chart, which I think is absolutely extraordinary. It's highly unusual, folks. I'm not going to go into the mathematics of it right now, but ever greater 10-year negative interest rates in Germany, the nice bounce back we've all enjoyed the last couple of weeks. And Mike Bell, just giving it away here with a slight concave feel as well. I mean, the nature of the give up here to new negative interest rates, ever greater negative interest rates, is really extraordinary, isn't it?
Yeah, it is. And I mean, I think it highlights the difficulty that investors in Europe have when they're looking to de-risk, because the yield on safe haven assets like government bonds is so low. So we find that a lot of clients here in Europe are looking to alternatives where you've got a slightly more attractive yield available. So things like core infrastructure, for example.
Janet, we've got about 20 seconds, but how are you trading or wanting to trade inflation-linked bonds in Europe, given the collapse in inflation expectations?
Yeah, so basically we see this as an opportunity, because what the break-evens are pricing in the Eurozone is basically very, very little sub 1% inflation. And we do think that with, the oil price rising, the very weak euro, and the fact that the ECB stimulus may work at some point later, we think that this is an opportunity to add to inflation-linked bonds in Eurozone, because they're just too cheaply priced.